Hello everybody and welcome back to the channel. So in this update, I'm going to go over what ETF I bought into my Rrsp. I really think this ETF is the best ETF. I'm not even exaggerating. I will go into what I bought in a second. So in the Rrsp, we're up 6% on the month, and all-time we're up 22%. For the Bank of Canada, they raised the interest rate by 0.5%, so it does seem to be trending lower. It's not that 0.75% that we've been getting, so hopefully that continues into the future and these rate increases don't keep going up, because it is affecting the price of assets, it's affecting the price of homes, and it's affecting the price of stocks to the negative, because it's more expensive to borrow money, it's more expensive to pay a mortgage now. So hopefully that continues to decline. If you want to follow along with my journey and just follow my buys and sells from week to week, or any news or earnings reports for companies that I own, please feel free to like the video so it reaches more people and we can help grow the channel. And also so you don't miss any updates, because I do regularly update here on the channel several times per month. With that said, let's roll the intro and I'll get into what ETF I bought in my Rrsp. Now let's get to it. What did I buy in the Rrsp? So we have Starbucks. I have 5 shares. I've had this for a while, and I bought SCHD. So this is a high yield U.S. dividend ETF. It holds about 100 different U.S. listed stocks that pay dividends. I chose this over any other fund because of the low management fee, the pretty good starting yield, the high dividend growth rate. And I'll be comparing this ETF to another ETF in terms of growth rate, and even some individual stocks, so you can get a better sense of why I selected this ETF in particular. So we have a little over 2 shares of SCHD, so I bought 2 full shares and then a fractional with the rest of the money that I had here from my deposit. Why did I buy it in my Rrsp, you may ask? Well, in Canada, the Rrsp is considered a retirement account by the IRS in the United States. So they do not withhold 15% of your dividend income from US listed stocks if they're held in this account. If I had it in my TFSA, they would actually withhold 15%. So you lose 15% of your dividends if you have it in a personal or a tax-free savings, because the IRS does not recognize the TFSA as a retirement account, unfortunately. So one way to mitigate that is to hold them into your Rrsp. So that's what I did. And I also wanted to lower my taxable income for the year. So that's another reason why I decided to make this purchase, because it is December. It is the final chance to kind of do that this month, if you can, depending on your circumstances, of course. But in general, I still recommend that everybody maxes out their TFSA as soon as you can. If you have the means, definitely do that. And then you can look into loading up on the Rrsp or even personal accounts or whatever else you want to get into. So if you want to take a look at the SCHD website, I would recommend using Microsoft Edge. Don't use Google Chrome, because the drop-down menus don't quite work properly. You'll put them out and then they'll immediately close up on you. It's actually quite annoying. So the expense ratio of the fund is very low, so 0.06% annual fee for ETFs. So unlike an individual stock, you have to pay fees for an ETF, so that can be kind of a con of an ETF. But if the fee is low enough, it shouldn't be too big of a deal. If I say I put $10,000 into this, I'd be paying $6 a year in a fee just for the ETF doing all the work for me, tracking all the stocks, changing all the stocks. I'm not really doing anything. You can just buy this passively, and they basically handle the rest. They'll handle what's in the fund, just based on a couple of metrics that they have. So the important part of any ETF is understanding what it contains. So it holds over 100 stocks. But the top 10 stocks are going to be Merck & Co., Amgen. So these are pharmaceuticals. IBM has been around forever. Pfizer, Home Depot. This is one I was thinking about owning individually. Cisco basically has a monopoly on networking equipment, at least in the high end, business to business networking. Definitely very, very good company here. Texas Instruments makes semiconductors, so very kind of the older semiconductors that have a lot higher margins. So this is a very good dividend growth stock on its own. PepsiCo and Broadcom is another semiconductor company, and Lockheed Martin, a very good defensive stock with a lot of government contracts. So the income is very safe with this company. So a lot of these companies I wouldn't mind owning individually. So there's a lot more. So if we go view all holdings, you're going to see that they own Coca-Cola, they own Verizon, BlackRock owns a lot of ETFs, Altria is a tobacco company, 3M, Wells Fargo, Kimberly-Clark, T. Rowe Price. There's a lot of recognizable names here. Kellogg's, Best Buy. So no small stocks, just large established companies that are larger, just to reduce the risk. Because with smaller companies there is more risk than investing in a larger company, and what the fund is trying to go for is just long-term, stable dividend payments to grow the fund. So with the selection criteria of the ETF, they have at least 10 consecutive years of dividend payments to be in the ETF, a minimum $500 million market cap. So no tiny companies will get into this. This minimizes risk, of course, because they're going for sustainable, predictable cash flow. And, you need to establish some history to even be in this fund. And they look for the best combination of cash flow to total debt. So they don't want highly leveraged companies that, produce very little cash flow relative to the total debt. So that's very good, because the only way for a company to go bankrupt is to have lots and lots of debt. So that it kind of ensures the safety not only of the dividend, but of the company itself and the longevity of the company. Return on equity, like can the company invest into itself and get a good rate of return? And then the dividend yield is a factor, and the 5-year dividend growth rate. So I'll be going into this shortly and showing you how important dividend growth rate is, but I really like that that's one of their selection criteria. And then they select the 100 highest yielding stocks among the universe of qualifying components. And then just to make sure that the fund isn't too concentrated in any one position, they max out any position at 4.5% weighting cap and a 25% weighting cap on any individual sector. So, let's say financials or technology, just to ensure that the portfolio is not too concentrated in any one company or any one sector, which is great if you want some diversification. And, you don't want to manage a portfolio of 10 to 100 stocks, because that's really not manageable for the average person. So here's a spreadsheet I made for a dividend growth model for SCHD, and just comparing it to a couple of alternative investments. So SCHD currently has a starting yield of 3.26%, and it's growing it at an average compound annual growth rate of 12% over the past 5 years. So I'm just taking the past 5-year average for growth rates for all of these different investments, and then just seeing how much cash flow they're going to generate me in the future, assuming that they continue growing at the same rate. Of course, that could change over time. The dividend growth rate could be higher, it could be lower. This is just a guess, but it's just a way to compare different dividend growth investments together, and then kind of seeing what the results are. And I think it's quite interesting. So SCHD will start at 3.26%. And then in year 5, because it's growing at that 12% rate every year, it hits 5.75. In year 10, 10.13% in year 10 is quite good for SCHD. Compare that with VIM. VIM is a lot more stocks than SCHD. It's over 440 stocks that are dividend paying. SCHD is a much smaller list of about 100, but we can see that VIM has a much lower starting yield, so that's going to be a factor, and it only grows at 5.8%. So after 5 years, it's only at 3.75. It's trailing SCHD by a whole 2%. In year 10, you're not even at 5% dividend yield for the fund. So we can see that SCHD maybe being a little bit more selective, maybe picking a higher quality basket of stocks over a higher quantity can lead to better results. And then I just compared VFE. You can just pick any S&P 500 index, but the starting yield for that is approximately 1.26%. And then the dividend growth rate of the S&P 500 is about 5%, just because the S&P 500 holds the 500 largest companies in the United States. Not all of them pay dividends. Some do. So that's why the growth rate will not be quite as good as a dedicated dividend ETF that only holds a dividend stocks. So we can see in year 5 that it hits 1.61% dividends for dividend, and year 10 it hits 2%. So VFE does not look like a great source of passive income. Not to say that it's not a good source of returns in the market. You definitely can get good returns buying into the S&P 500. However, if you're after passive income, it looks like VIM or SCHD are much better options if cash flow is your primary concern, not so much the capital appreciation, which again is never guaranteed and may or may not happen, because you could have 10 years where the market just doesn't do anything and all your returns are going to be dividends. And then I just picked a couple of stocks. So I picked 2 Canadian stocks and then 2 American stocks that people like, and I'm invested in 3 of these. I don't have any Coca-Cola. I decided to go for SCHD over that just because, as we can see here with the results. So Couche-Tard is ATD, so that's our convenience store company. So less than 1% starting yield, but you have to keep in mind it's growing its dividend at over 24% on average every single year. So we can see this goes insane. So in 5 years, we're expected to have a yield of 2.68%. So from 0.91, we're almost tripling our dividend in 5 years. That's absolutely insane. And then in year 10, we're at almost 8%. So our dividend has grown by 8-fold over that time period. We can see SCHD has tripled, going from 3 to 10, like a little bit over triple, but this is 8 times. So if we actually took the spreadsheet further and I went 15 years out or 20 years out and they could maintain such a high growth rate for their dividend, it could easily be the best investment for cash flow. It just may take a while to get there because of the really low starting yield. So dividend growth rate is very, very important when you're picking an investment. Scotiabank is starting at 6% right now, very, very high starting yield. They grow it at a medium pace, 6%, and we can see in year 5, we're going to be getting 8% in dividends. So we can see that because the growth rate is not so high, it's not really going up there. But every year, because it starts so high overall, in year 10, we're getting over 10%, an over 10% yield on cost. So whatever we invested, we're getting 10% now if we wait a decade in Scotia, assuming they can continue increasing the dividend at a 6% average for that decade. Starbucks is another stock I have. So right now they have about a 2% starting yield, not too high, very high 5-year average growth rate though of 16%, and they are going to be growing their EPS at very, very high rates over the next 3 years from what they said. So we'll see what happens to the dividend. If it does happen, definitely very interesting. So year 5, we're over doubling our dividend. We're at 4.33, so from 2, not bad. And then we're at 9. So that's almost, 4.5 times the original dividend yield because the growth rate is so high. So Starbucks, even though the yield doesn't start off so great, pretty decent. And then the last one is Coca-Cola, starts at 2.79. In year 5, you can expect 3.67 if it continues to grow at the 5.61% rate. In year 10, you'll get 4.82%. So a little less than double. It's not great. The dividend yield is pretty solid. It's a pretty defensive company, but I don't see why I would invest in Coca-Cola individually if I'm after passive income and total return. It looks like SCHD is just the clear winner here, getting a 10% yield on my money for any dollars invested today into year 10. And then at the bottom, I just have the total percentage earned in dividends. So we can see that Scotiabank is actually the winner. So it's at 83.83% in just dividend income. So just percentage of money returned to me over that decade. SCHD is going to be second place at 64. Starbucks is going to be third at 51. So we can see those high dividend growth rates really play a factor in your overall total return. Vim is only at 40 just because the yield is lower. It grows at half the rate of SCHD, and we can see that's a huge difference of 64 to 40. SCHD definitely better if you're looking for more cash flow. Coca-Cola 38, so about close to Vim, where it has a lower yield, kind of a middle of the road growth rate. ATD's at 36% of our money back in just pure cash flow. Although with this one, you have to keep in mind that the company is a growing company, and the stock price can appreciate alongside this, and it could prove to be the best investment overall. Whereas, something like BNS, maybe the stock price won't move much, but you'll get 80% cash. So the stock performance is part of your return, not just your dividends. Just keep that in mind. And then the S&P 500, only 16% earned in dividend income, but of course, it's more of a growth fund. I'm just doing it to demonstrate how much passive income these different investments can generate. It does not mean that will be your total return. So whatever the share price performance over the decade is, plus these dividends is going to be your total return. So if the share price goes down, that's minused out of your income from your total return. If the share price is appreciated, that's part of your total return. And if you'd like to start investing yourself and you haven't already, feel free to use my link for WealthSimple in the description below. If you make a deposit and sign up using that link, you will help support the channel, and you will receive up to a maximum of $3,000 for doing so. So moving along to the dividend portfolio tracking, I've earned $956.07 in dividends since starting the portfolio. My annual dividends have increased since the last update from $922.57 to $928.46. The monthly average has gone up from $76.88 to $77.37. So nice little progress there. The weekly average, we're up from $17.74 to $17.86. Daily, we're making an extra penny every single day, which is great. So $2.54 a day instead of $2.53. The months to earn $100 is how I'm tracking the dividend snowball effect. So I'm just tracking how long does it take me to get $100 from my dividend income in general. Instead of 1.3 months, it's down to 1.29. So that's moving along. And then if my portfolio were working a job for me, a 40-hour week job, it got a raise. So it's now earning 45 cents per hour for a 40-hour work week versus 44. We're getting closer to my goals of hitting $3 a day in dividends, because we're at $2.54 now. We're getting close to a $100 average because we're increasing after every update. So we're up to 77 now. So, $100 is well within sights. I mean, it will definitely happen sooner rather than later. And then $1,000 in annual dividend income. We're up to $928.46. So this isn't too far off. And all-time dividends is also going to hit $1,000 fairly soon. So we're at $956. So overall, pretty decent, pretty happy where the portfolio is. In the comments section below, just let me know what your favorite ETF is in the comments section below. All right, have a good one.